welcome everybody to our monthly Money Life webinar. I'm Jim Allen, CEO and Chief Financial Planner here at Anchor Bay. And joining us as usual is Blake Pinion. Blake is one of our financial planners here at Anchor Bay. He's also one of our tax specialists. He's a certified financial planner and an enrolled agent. And many of you have worked with Blake either on your financial plan or your taxes. So a little housekeeping. Again, someone maybe raise your hand. Let me know that you can hear us okay. Okay, great. So we're good there. This is being recorded. And so we'll have it posted on our website probably sometime early next week. So if you can't make the whole thing or you want to watch it again, you can go ahead and go back to our website and view the presentation. And all of our prior Money Life webinars, we try and do these, once a month for most of the months of the year, are all available to you to go back and watch it at your leisure. Next thing is, in terms of questions, we wanted to leave a lot of time in this presentation for your questions. We'll save those until the end. But if you have a question that pops up, you can either use the Q&A feature or the chat feature and just post your question in there, and then we'll make sure we get to all of the questions at the end of the presentation. So let's go ahead and get started. So our topic today is year-end tax planning, and we do this pretty much every year in some form or fashion. And so, we're going to talk about some things that we could still do this year to help minimize taxes. Unfortunately, we don't have as many tools in the toolbox as we used to have, but there still are things we can do. And so Blake and I are going to go through the bulk of these. So kind of what we're going to cover, the first one are some tax cliffs, pretty much extra tax items that maybe you don't think of in terms of a tax bracket, but cause extra tax. So we're going to discuss avoiding those tax thresholds. And we'll talk, like we always do, we preach constantly about Roth IRA conversions, how those work. We're going to talk about tax loss harvesting. For those of you where we're managing your taxable accounts, this is a strategy we can use. It's typically pertinent right now with the market volatility we've had. We'll talk about some business planning strategies for those of you that are sole proprietors or have a LLC or S Corp, things like that. Blake's going to cover health savings accounts. He's going to cover a checklist to make sure you're making the proper contributions to your retirement plans, you're taking the proper retirement required minimum distributions, etc. He's going to talk about how you can use your IRA to fund your charitable bequests. He's going to talk about maximizing your itemized deductions, how bunching them together. And then he's going to give an update on the recent student loan forgiveness bill, that executive order essentially that President Biden signed into law. And so he'll give you an update on how that's going to work, what we know at this point, and then allow you to ask any questions at the end. So let's go ahead and jump into it. So the first strategy, and it's something we look at all the time, are avoiding some of these tax cliffs. So, a lot of people will think, okay, if I have extra income, I'm going to go from, say, the 12% bracket to the next higher bracket or whatever. But there's these other additional taxes or means tested type of premium increases, et cetera, that essentially work like a tax increase. And most of these are cliff based, meaning that you get $1 over and all of a sudden you're subject to these taxes, where $1 under you're not. So planning that we can do here is to make sure if we're getting close to these thresholds, we don't do anything to throw you all of a sudden into these tax cliffs, or maybe there's some things we can do in terms of deferring income, things like that, to keep you under these thresholds. So we'll talk about these first. So the three biggies are the 3.8% net investment income, or commonly called the Obamacare tax. Then you have something called IRMA, which applies if you're on Medicare, and it's the approach to means testing Medicare premiums, but it essentially works like a tax. And then we'll talk about how you can make your Social Security benefits taxable and the levels where you can avoid taxation. So as I said, all of these are kind of cliff-based. Once you exceed the numbers, now your income is going to be subject to these additional taxes. So let's start with the NII tax. Not everybody's subject to this, but again, it's something we've got to look out for and make sure we're not doing anything to throw you into the NII. So it's a 3.8% additional tax on investment income only. So this doesn't apply to your W-2 wages or anything like that. It applies to investment income. So your interest on your bank accounts and your CDs and your bonds and things like that. Dividends from stocks and mutual funds, capital gains from the sale of stocks, from the sale of real estate. It applies to annuities. So all of these are investment income, and you can be subject to this additional 3.8% tax once you exceed the threshold. And that threshold kicks in at 200,000 at single and 250,000 married filing jointly. And this is an adjusted gross income. It's not taxable income. So that's what makes it a little more difficult to plan around, is almost all of these are adjusted gross income. So essentially what that does is, let's say you're in the 15% capital gains bracket, now you're in the 18.8. Or if you're in the 20% capital gains bracket, now you're in the 23.8. So we want to avoid this as much as we can. There's not a ton we can do here. Like I said, the main thing is keep you below the threshold. So let's say your income's looking like it's going to be 195,000. We want to make sure that we somehow keep you under that 200,000 threshold if you're single. So get you below the threshold, which probably the most common way is, if you're working, is to kind of increase what you're putting in your 401k if we can, because that reduces adjusted gross income. Or if we can't get you below the threshold, I mean your income's just going to be too high, then the next thing we try and do is, okay, we know you're going to be subject to the NII tax, but maybe there's some things we can do to reduce the income that's subject to NII. So in that case, maybe now we're looking at deferring it in a deferred annuity, or we're not going to trigger capital gains, or we're going to use municipal bonds, things like that. So there's not a ton of planning we can do here. Really, the thing we're looking for is to make sure that we're not doing anything that inadvertently triggers this, and now you're paying some additional tax on your investment income that maybe you didn't have to. So that's one of the reasons when we're doing our year-end reviews, which we're starting next week, is we're want to run tax projections and see how close are we to some of these cliffs, and make sure that whatever we're doing, we're trying to minimize the impact of these as much as possible. So that's the Obamacare or NII tax. All right, we're gonna do it this way then. The next one is IRMA. So this, I believe, stands for Income-Related Medicare Adjustment Amount. Correct me if I'm wrong, Blake. It's something like that. Mm-hmm. So this is a surcharge. So normally when you're on Medicare, you have to pay for your Part B, your health insurance portion, and then Part D is your prescription drug. Your hospital coverage, Part A, you don't pay for, but you do have Part B and Part D premiums, and there's a base level, and I'll show you what those are in just a minute. But this is means tested, meaning as your income grows, the amount of premium you have to pay increases, and it increases pretty dramatically. And I'll show you an example in a couple slides. So the way this works is when you go on to Medicare, the testing for IRMA is they're going to look at your tax return 2 years prior. So for 2022, they're looking at your tax return for 2020. And if you're above these thresholds, then you've got to pay the additional premiums. Now, there's a strategy that we use all the time with our clients that are retiring is, let's say 2022 was like your best income year ever because you were still working, highly paid compensation, that kind of thing. But now you're retired, and so that income's not going to be at the same level. There's a form that we can fill out and submit to say, hey, that income really doesn't reflect what my income is going to be going forward, and we can get that Medicare premium reduced using that waiver form. And so Blake does these all the time with our clients, is to make sure that the Social Security Administration knows that really you're not going to be subject to IRMA going forward. So here's the bracket. So let's look at, say, a married couple. So if a married couple's modified adjusted gross income, which for the most part is adjusted gross income, if it's below 182,000 for this year, then your Part B premium is $170, And then your Part D is whatever you're paying for your prescription drug coverage, which may be something like $40. So, you know, maybe $210 to $220 total per month for each individual. So if you're a married couple, we're talking $440. But then let's say you're up in the next bracket, you know, starting at 182,000 to 228. Now your premiums jump from 170 to 238, and your Part D premiums also gone up by $12.40. And then you can see if you're above 228, now it's 340, and so on and so forth till you get to that last bracket where now your premium's $578 plus $77 additional IRMA on your Part D. So you can see it ramps up pretty quickly. And you know, this, if it's a married couple, double each of these premiums because these are the individual rates. So the idea here is we always want to be extremely careful that we're not doing planning that all of a sudden throws you into the next higher IRMA bracket, because you can see these jumps are pretty significant. So let me just kind of show you what this looks like. So let's say 2022, we have a single person. So the bottom threshold's 114,000. So their Medicare B and D, not counting supplements, this is just Medicare premiums, is roughly $250 a month or $3,000 a year. So if we take that as a percentage of their adjusted gross income, it's only 2.6%. But if we look at, okay, instead of 14,000, it's now 14,001. And so now you've moved up to the next higher bracket. Now we're looking at $372.30 a month. So that's $122 a month increase, $44.68. So now that's 3.9%. And again, if it's a married couple, double that. So we've gone from $500 a month to almost $750 a month. So just that one extra dollar, an extra dollar of capital gains or interest or anything like that, or even wage income, you know, that now costs you almost $1,500 in additional Medicare premiums. And so that's why we want to be really careful. It's like if we're getting close to these thresholds, maybe we need to increase your 401k allocation for the year. Or maybe we need to do some tax loss harvesting that we're going to talk about. Whatever we can do to get your adjusted gross income underneath that threshold, because that's essentially a tax increase. I mean, that's, you know, going from 2.6 to 3.9, that's a 1.3% essentially a tax increase on top of whatever bracket you're already in. So that's IRMA. The next one is Social Security. And so, you know, if you've attended our Social Security seminars or webinars, you know that generally Social Security, if you're below certain thresholds, you don't have to pay tax on it. But if you exceed the thresholds, now it starts to become taxable. And so the thresholds for a single individual is 25,000, and that's modified adjusted gross income. So what that means is your normal adjusted gross income plus half of your Social Security benefits. They add that together. If the number exceeds 25,000, then half of your Social Security benefits are now taxable. And then if they exceed the next threshold, 34,000 or 44,000, if you're married, now 85% of your Social Security benefits are taxable. And so it's right there on the 1040. It shows you Social Security benefits under line 20A, and then the taxable amount under line 20B. And the good news is you don't have to pay tax on your Social Security benefits in California, one of the rare tax breaks that our state gives you. But you don't have to pay tax on California. But again, $1 over now throws your Social Security benefit to where you're either half of it's taxed or 85% of it's taxed. So we call that the Social Security tax torpedo. Again, it's just like IRMA. You know, we inadvertently add an extra dollar to your income, and now we've created a tax situation for your Social Security benefits, which in theory could then bump you up into another higher tax bracket, throw you into NII, you know, all kinds of other things. So whenever possible, we try and make it so your Social Security benefits aren't taxed. These are tough thresholds to keep under, but we can do it. I mean, we got plenty of clients where we're doing planning where we're keeping their income below those levels, at least maybe for a period of time. They're living off cash, something like that, so that we can at least not have to pay tax on all of your Social Security benefits. The good news is even if you have to pay tax on your Social Security, worst case scenario is you get 15% of your benefit tax-free federally. You get all of it tax-free from California. Okay, the next one, and this is one we preach all the time, virtually all of our tax planning webinars, etc. Roth IRA conversions. If you've attended our webinars in the past, you read our blog postings, we're huge proponents of what we call tax diversification. Just like we don't have all your investment portfolio in one, all the eggs in one basket, we want to do the same thing from a tax standpoint. What we typically see is a lot of clients, it's like, okay, I'm in a high tax bracket, I don't want to pay more tax, I'm going to just put everything in the 401k, or I'm going to make contributions to the IRA and take a tax deduction. That's great because it minimizes current tax, but what you're doing is you're creating a time bomb for down the road, because when you take all that money out, it's going to be subject to income tax. And you have required minimum distributions, which could be significantly higher than you expect. And so a lot of people are thinking, oh, I'll be in a lower tax bracket in retirement, therefore it's okay to defer this tax. Not necessarily. A, you can end up with a significant amount of money you have to distribute each year. B, you don't know what tax brackets are going to be in the future. And the other thing we talk about all the time is, tax rates change every 4 or 4.5 years, and that seems to be accelerating. And so, yeah, we're in a low tax bracket environment today relative to historic rates. That very well could change in the near future. And when the time comes that you need to start taking the money out, or you have to start taking the money out, you very well could be in a higher tax bracket. And then the next problem with having all your eggs in one tax bucket is, let's say you have a problem at your house. You need to spend $25,000 to replace your roof or something like that. Well, if all I have is a 401k or an IRA, and I have to take $25,000 out, that's taxable, and now I have to pay the tax. So you get into this kind of vicious cycle where now to net 25, you have to take 40, depending on your tax bracket. So what we always want to do is have money in other buckets that we can tap into. One of the biggies is a Roth IRA. So with a Roth IRA, you don't pay tax on any of the earnings after age 59.5 and holding the Roth IRA for 5 years. Before that, you can always take out whatever you contributed tax-free. So with a Roth IRA, you pay tax going in, but you'll never pay tax again if it's done properly. You also don't have required minimum distributions. So this is a great bucket, not only for future tax-free income and for legacy purposes, because your heirs, when they inherit it, they don't have to pay the tax either. But it can be used as a great emergency fund. The money you have in the Roth, whatever you've contributed, either through contributions or conversions, we can take out tax-free. And if you're over 59.5, then we can take out the gains tax-free as well. So now if I need to pull 25,000 to put that roof on, if I've got it in a Roth IRA, I can take it out tax-free. I only need to take 25,000. I don't need to take 40. So we want to build up a bucket of Roth IRA money as much as we possibly can. Now, the downside is you have limitations on how much you can contribute, if you can contribute at all, because you have income limitations. But even if you can't contribute to a Roth IRA, you can convert your regular IRA to a Roth IRA. And that's what we're talking about here, is setting up a systematic program where we're periodically and systematically doing partial Roth conversions of your regular IRA to a Roth IRA. Now, we're not going to tell you, you got a $500,000 IRA, let's convert it to a Roth, because now we've thrown you into the top tax bracket, we've thrown you into NII, IRMA, everything else. So what we do is we just do a little bit each year to ideally keep you in the same tax bracket, maybe avoid those cliffs. And there's no age or time limit on this. We can do this for your entire lifetime if it makes sense to do it. So let me kind of show you how we would normally do this. So let's say we have John. John has income of $30,000, so he's in a 12% tax bracket. Well, we know at the top of the 12% tax bracket is $40,000. So what we'll do is we'll convert $10,000 of his Roth IRA or his IRA to a Roth, So he now has income of 40,000, but he's still in the same 12% tax bracket. So did we pay tax on that $10,000? We did. It's, you know, it's costing us 12% of that. But we'll never pay tax again. And so as that grows, we don't have to worry about paying taxes. We don't have to worry about RMDs, et cetera. So this is typically how we do it, is little chunks each year, whenever possible. If we're in a year where we have maybe a lower income, you're laid off, or you just went into retirement, or you're living off of cash, or you made large charitable contributions, whatever it is, then we do larger Roth IRAs. But we want to just build that bucket up over a long period of time so that you have it for tax diversification in the future. And so normally this is what we would do, is like we'll go right to the top of your tax bracket. And and if you're in a 35% tax bracket, it may not make sense to do it. It still may, because that 35% bracket could be a 50% bracket in the future. I mean, rates have been as high as 90% before. So it's not out of the realm of possibility that they could go that high. But at the same time, not only do we not want to throw you into the next higher tax bracket, we've got to look at these other things like IRMA and like Social Security. Another one we look at is Covered California. If you're receiving the premium tax credit because you're below certain income thresholds, and we've done this with a lot of clients that are, say, living off of cash, they're getting all of their medical coverage covered under the premium tax credit. We don't want to do conversions that now causes you to lose your premium tax credit. Health insurance could be $1,000 a month or more. And so we don't want to do that. But the other thing we also don't want to do is throw you into a higher capital gains bracket. There is a 0% capital gains bracket, which the numbers are pretty liberal. I believe it's about 83,000 for a married couple, where your capital gains aren't taxed. And so we want to make sure we're not doing something that all of a sudden we lose the benefit of that 0% capital gains bracket as well. So we're always, when we're running our projections, we're always looking at, like, should we be doing a Roth conversion? How much can we convert? And, does it make sense? You have to pay the tax. So we have to look at, do you have cash somewhere to be able to pay the tax? Have you done enough withholding? Are you making estimated tax payments? Whatever the source is. But this is huge. We definitely want to have a bucket of money, Roth or just a regular old taxable investment account, that we can pull from as needed, or we blend all of these to ideally keep you at as low a tax bracket as we possibly can in the future. Okay, so the next one, and this is really relevant right now, is tax loss harvesting. So this only applies if you have a taxable account, a regular investment brokerage account where you're currently paying tax on your interest, your dividends, and capital gains for sales, all of that kind of stuff. If you have one of those accounts, then what we'll do is, when we have a market downturn like we have now, or where we really took advantage of this was during the COVID downturn in 2020, because that was extremely short-lived. So we may take a stock that we still like, but it has losses in it because it's just caught up in the market in general, and we'll sell that stock and we'll bank that loss. And so we can use that loss of that stock against gains in other stocks that we maybe want to get out of, or reallocate or rebalance. And not only can we offset gains from other sales, we can also, even if we've netted all those out, we could still go up to $3,000 against your ordinary income. And anything that's left after that, we can carry forward and apply in future years. So we do this technique a fair amount, and it's deliberate. So it's like, most people think, oh, it's never a good idea. Why are we selling when the stock's down? Because we expect that the downturn is temporary. Or a lot of times what it is there's another stock in the same sector that we think is probably comparable. Say, for example, we had you in Exxon, and Exxon's taken a dip and you have a loss in it. We may sell the Exxon stock, bank that loss, and then we'll go buy Chevron or some stock that has similar financials to it. And then we'll benefit from the return, the return to profitability but we can use that loss to minimize income. Now, if we're going to say sell out of Exxon and then rebuy it, we have what's called the wash sale rule. So we normally need to wait, 30 days plus to get back into that same stock. But we use this technique all the time in taxable accounts. Tanner and the investment team are constantly looking at the portfolios to see where we can take opportunities from this. And like I said, we did this in 2020, when the market cratered in March and then recovered several months later. And we were able to bank, significant tax losses that we're using still on our clients' portfolios. And so tax loss harvesting is a super effective technique, maybe to get you below those thresholds, et cetera. We can only use this in taxable accounts. We can't use it in your retirement plans like your 401k, your IRA. Okay, one more for me are business deductions. So if you're a business owner, you're sole proprietor, or you're an LLC that just has one member, or things like that, there's opportunities for us to evaluate taking business deductions. And again, a lot of times we want to look at, maybe there's things we want to accelerate those expenses, or we want to defer those expenses. So we can, again, kind of play with the timing of when we're going to do these. A biggie is what's called Section 179. So that's, you're going to go out and you're going to buy a new laptop. And normally what you'd have with a piece of equipment like that, or real estate or anything else, is you have to depreciate that over whatever the time horizon is. Something like a computer, I believe it's 5 years. But the alternative is, let's say you paid $3,000 for the computer. We can do what's called Section 179 and say we're going to deduct all $3,000 this year. And instead of depreciating over that 5-year period or 3-year period or 7 or whatever the time frame is for the particular asset, we can just deduct it all in 1 year. And so again, that allows us to kind of manipulate the profits and maybe reduce the income for this year, or maybe we defer that expense until the following year when we might need it more. Obviously, if you're self-employed and your home is the only place you work, you don't have an office anywhere else, we can take advantage of the home office deduction. That's a red flag in a lot of cases, and there's some strict rules around it. But certainly, if that's your place of business, then you're entitled to take that home office deduction. And the next biggie with a lot of business owners is, we evaluate, should you have a retirement plan? A lot of things come into play there. What's the profitability of the business? What's your age? How many employees you have? But we can set up SEP IRAs. We can set up simple IRAs. We can set up a full-blown 401k. If you're in the right age group, say north of 50, and you don't have a bunch of employees, and the business has really reliable cash flow, we may do a good old-fashioned pension, because that allows you to really sock away a lot of money in a short period of time and minimize taxes. If you're buying your health care and you're self-employed, there's a deduction for that. And the other things to look at are the choice of the entity. Are you going to be just a sole proprietor? You're just doing business under your own name, or some other name, but everything's flowing through to your personal return. Are you an LLC? Are you a C corporation, an S corporation? We can help you figure out what the right type of entity is for your individual situation. And we can also prepare returns for any of these types of business entities. So if you have a business, whether it's your sole source of income, or whether it's a sideline business, a lot of our retiree clients, have kind of their side hustle. We definitely should be looking at, are there business planning opportunities we can take advantage of? Okay, so I'm going to turn it over to Blake and let him finish out the rest of the strategies here, and also talk about the student loan thing. And after that, we'll go ahead and then open up the questions. So Blake, take it away.
All right, thank you, Jim. So as we talked about a little bit earlier, we're gearing up to do our fall year-end reviews. And as part of that process, we go through a year-end checklist to make sure that we're covering all our bases, going over all the topics that should be addressed before the end of the year. So we listed some of those common topics we discussed during this meeting. So this is IRA contributions, 401k contributions, health savings accounts contributions, qualified charitable distributions when applicable, and required minimum distributions, making sure those are distributed before the end of the year. So let me go into each of those in a little bit more detail. So starting off with IRA contributions. So for the 2022 tax year, if you are under the age of 50 and you have earned income of at least $6,000, that's the maximum contribution you can make. If you're over the age of 50 or 50, you can make a $7,000 contribution. So you get an additional $1,000 catch-up contribution. Again, you have to have earned income to be able to contribute to an IRA. So what's unique about IRAs is you have up until the tax deadline to make your IRA contribution. So if I wanted to contribute for this year, 2022, I actually have up until April 15th of 2023 to make a 2022 IRA contribution. But from a year-end planning standpoint, we want to forecast and project out your income to see, if it does even make sense to contribute to an IRA. The next is a 401k contribution. So if you're an employee, likely you have access to a 401k, and the contribution to that for 2022, if you're under the age of 50, is $20,500. If you're age 50 or older, then you get an additional $6,500 as a catch-up contribution. So a total of $27,000 you can contribute to a 401k. And this is synonymous as well with the 403B and 457 plan. They all have the same contribution rates. And then for the IRA as well, a traditional IRA and a Roth IRA, your maximum is $6,000 if you're 50 or if you're under the age of 50, and $7,000 if you're 50 or over. Health savings account, I'm going to get into this in a little bit more detail in a few minutes, but the short answer is not everyone is eligible to contribute to a health savings account. You have to be on a high deductible health plan. So for those that are eligible, individuals can contribute $3,650 to their health savings account. And for family plans, that doubles to $7,300. And like the IRA, you can make an HSA contribution, and HSA is short for health savings account, by the tax deadline. So I can put in a 2022 HSA contribution up until April 15th of 2023. So all these three type of accounts, you may be wondering, which one do I contribute? How much do I contribute to it? That's where we come in as the trusted advisor to help you weigh through those type of decisions and analyze what's best for your particular individual situation. Qualified charitable distributions, I'm going to get more into these into the next slide, but to give you a preview, essentially, this needs to be done before the end of the year, and you're sending money directly from an IRA to a charity to avoid taxation. Required minimum distributions, I'm sure a lot of you are familiar with these. The nuts and bolts of it is that once you reach the age of 72 and you have a qualified retirement account, the IRS comes knocking on your door and they require you to take money out of that account. And the amount that you take out depends on the balance of that qualified retirement account. It could be an IRA, it could be a 401k as of the previous year and your age. So the higher your balance in your IRA and the older you are, the larger required minimum distribution you have. So why are required minimum distributions so important? They're important because you need to distribute them before the end of the year, or you could face a 50% penalty, which could be devastating. Say I have an RMD of $20,000 and I don't distribute it before the end of the year, I could have to pay the IRS $10,000 in penalties. So it's super important and critical to distribute your required minimum distributions on time. And the exception is Roth IRAs. They don't have that required minimum distribution requirement. Next slide, Jim. So the next strategy is charitable IRAs. So essentially using an IRA for charity via a qualified charitable distribution. So I alluded to it a little bit earlier, but essentially the strategy here is I'm using money from my IRA and sending it directly to charity. And I can do up to $100,000 of that per year. And notice how he said IRA, because this strategy is not available with 401k plans. So there's multiple reasons why this is an attractive strategy. And the first is because it counts towards your required minimum distribution. So those that are age 72, they have to take out money from their retirement accounts. They could do a qualified charitable distribution, and that will fulfill their RMD requirement. So if I have an RMD of $20,000, I can send $20,000 from my IRA directly to a charity, and I satisfied my RMD. So I accomplished two goals. I gave back to charity and I fulfilled my RMD. But the consideration with this is you have to be at least 70 and a half. So not everyone can do a qualified charitable distribution, or QCD for short. You have to be at least 70 and a half. The other advantage of charitable IRAs, qualified charitable distributions, is they're tax neutral. So I don't have to pay tax on the money that's taken out of my IRA that I donate to charity, but I also don't get a tax deduction for it. So it's essentially a wash. So you don't get a tax benefit for the donation, but I don't have to pay tax on the distribution. Whereas IRA distributions, normally you pay 100% ordinary income tax. So it's really a benefit to you to be able to avoid this by donating it to charity. Another advantage is it lowers your IRA balance for later taxation. So you remember I said, the higher IRA balance you have, or the higher IRA balance, the higher required minimum distribution. So if you have a lower IRA balance because you're donating money to charity, you're going to have lower RMDs, which means less taxation. So this is ideal for people making charitable gifts. This is commonly associated with those that are charitably minded, and maybe if they want to use it to fulfill their RMD, they don't need the money from their required minimum distribution. But it would not be beneficial for someone who's itemizing. So if you're leaning on that, charitable deduction you get from itemizing, it may not be effective for you. From a year-end standpoint, again, this needs to be done before the end of the year. So that's why we explore the opportunity for those who it applies to. So the next strategy here is health savings accounts. And health savings accounts are arguably the best vehicle out there from a tax standpoint due to their triple tax benefit. So money I put in, I get a tax deduction, I get tax deferred growth, and then money I take out for qualified medical expenses that I don't have to pay taxes. So let's dig into that a little bit more. My contributions I make to an HSA, a health savings account, are tax deductible. So they lower my taxes on the front end. But as I mentioned earlier, not everyone can contribute to an HSA. You have to be on a high deductible health plan. So maybe you're wondering, what is a high deductible health plan? Well, you have to have a minimum deductible in 2022 of $1,400 for individual plans, $2,800 for family plans, and a maximum out-of-pocket cost of $7,050 for individual plans and $14,100 for family plans. So, piece of advice: review your health plan at work and see, do I meet those minimum deductibles and maximum out-of-pocket criteria? If so, then you can open and contribute to an HSA. You want to be conscious of those contribution limits that we mentioned. And then you also want to note that you can only contribute to a health savings account prior to Medicare age. So 65. Sorry about that. So you can only contribute to an HSA prior to Medicare age. And then the next benefit you get from an HSA from a tax standpoint is tax deferred growth in the account. So a lot of people don't think of HSAs as investment accounts. They think of them as savings accounts, money set aside in cash to pay for medical expenses in the event I need it, which is valid. But you can invest in an HSA for long-term growth, and the taxes that are triggered from the investments within the HSA are deferred because they're under that wrapper. So it's a great way to invest money and grow that account over time and defer taxes. So our advice here at Anchor Bay, we don't advise investing 100% of your HSA due to the fact that we think it's important to have some cash in there to meet the deductible. But we often encourage our clients to invest a portion of their HSA to grow it in retirement, as it's so crucial to have. So that's the second tax benefit. And then the third would be tax-free distributions for qualified medical expenses. So as long as you take out the money, use it for qualified medical expenses, you don't have to pay taxes. So that's the triple tax benefit. From a year-end standpoint, if you're an employee, a lot of employers have been offering HSAs as part of their employee benefits package. So the advice would be, check your employee benefits package, see if your employer offers it, and then you can evaluate whether you should do that with the combination of the high deductible health plan or a low deductible health plan. Because is an HSA right for everyone? Absolutely not. For those families and individuals that maybe go to the doctor frequently, use their health plan a lot, have ongoing medical expenses, it may be more prudent for them to have a low deductible health plan. So that's kind of the nuts and bolts of HSAs.
Yeah, and I'll just add too. I mean, a lot of people, if they have an HSA, they think it's like we're going to contribute and then we're going to use it like in the same year or shortly after. What we recommend, if your spending plan allows it, is to pay for current healthcare expenses from just your normal savings and cash flow, and let the HSA grow so that you have a source of funds in retirement to help pay for those healthcare costs, which are likely higher in retirement. So the strategy is don't spend the HSA on current medical expenses, spend that out of current cash flow, let this grow tax deferred for as long as possible, and then use it for healthcare expenses in retirement.
And go ahead, next slide. Yeah. Okay, so the final strategy I'm going to cover is bunching itemized deductions. So before we get into the standard deduction and itemized deductions, let's take a step back and explore where these come into play within the context of your tax situation. So when we file your taxes, there's a calculation made of whether you're going to take the standard deduction or itemized deductions, and you take the larger of the two. So your standard deduction is a flat stated amount that's published year to year, and it's adjusted with inflation. So for 2022, the standard deduction for married filing jointly is $25,900. For single filers, it's $12,950. If you're over the age of 65 or blind, you get an additional $1,400. Itemized deductions, on the other hand, are more personal to you, and you could have some flexibility to adjust them. So the primary four itemized deductions are your state and local taxes is the first one, and there's a $10,000 cap on these at the federal level. So when I say state and local taxes, I'm primarily talking about your state income taxes and your real estate property taxes and your DMV fees. Us Californians, this $10,000 cap that was signed via the Tax Cuts and Jobs Act in 2017 really hurt us because we notoriously have high property and state income taxes. So in addition to this, you have your mortgage interest, which is pretty self-explanatory, medical expenses above 7.5% of adjusted gross income, and charitable contributions. There's a few other itemized deductions like theft and casualty losses and other miscellaneous ones, but these are the core four. So those are your core four, and breaking it down even further, there's a few that you can control and a few that you can't control. So your state and local taxes and your mortgage interest, those are probably going to stay relatively the same year to year, but your medical expenses and your charitable contributions, you might have a little bit more flexibility, and that might vary year to year based on what's going on within your life. So the bunching itemized deduction says, let's load up all of our itemized deductions in 1 year to maximize it in the year that we think our itemized deductions are going to exceed that standard deduction, because that's the whole point. We're taking the itemized deductions when they're exceeding the standard deduction level. So I think it's a lot easier to understand in an example. So let's say that I have a surgery plan this year, and I know it's going to be a major medical expense. It's going to cost me thousands of dollars. And as a result, with that surgery, I'm probably going to be getting to a level where my itemized deductions are close to exceeding my flat standard deduction amount based on my filing status. So the bunching strategy says, based on that and the fact that, say, I contribute, $5,000 to charity every year, maybe I want to front load and do a big charitable contribution in that same year that I have my surgery, in order to maximize my itemized deduction. So maybe I do a $15,000 charitable contribution in that same year that I have my medical expenses, and that's going to be my charitable contribution for 2022, 2023, and 2024. And you can still give in 2023 and 2024, via like a donor advised fund. But the main point is that we're loading up on our itemized deductions in 1 year. So that's the heart of it. And that can apply to mortgage interest too as well. Say you bought a home or refinanced and you had to pay a lot of points and deductible mortgage interest, you can inflict that same strategy with your medical expenses or charitable contributions. So from a year-end standpoint, this needs to be done before the end of the year. So this is where we monitor as your trusted advisor, hey, is there an opportunity to bunch itemized deductions? So I'll wrap up with the last slide talking about the student loan debt relief. So I'm sure a lot of you've seen this in the news, heard about it. This is fresh off the press. It was just announced last month by President Biden that $10,000 of student loan debt is being forgiven. And if you're a Pell Grant recipient, that number goes up to $20,000. What's the catch with this? Not everyone is eligible for this relief. Specifically, your 2020 or 2021 adjusted gross income has to be less than $125,000 if you're a single filer, or $250,000 if you're a married filing jointly filer. If you're head of household, it's $250,000. If you're married filing separately, it's $125,000. These are cliff income limits as well. And Jim talked about cliff earlier in the presentation. But if you had, let's just say $125,001 of adjusted gross income in 2021, you wouldn't be eligible for this forgiveness. Another crucial detail about this package is it's federal student loans only. So if you or someone that has a private student loan, they wouldn't qualify from this package. And because it's based on 2020 and 2021, there's not a lot of planning we can do. The best is just to educate us on how this is going to work mechanically. So from a tax standpoint, it's all indications have shown that it's going to be tax-free at the federal level, this forgiveness, but states may not conform to this tax-free forgiveness. So California, for example, may recognize this forgiveness of the student loans as cancellation of debt income, which could be 100% taxable. So from a year-end planning standpoint, if you or someone who qualifies for this program, you could tell them that their balance is going to be automatically adjusted within their portal. There's nothing they need to do, but be cautious that they may face additional state income taxes depending on the state that they live in and how they're conforming to this new legislation. So now we'll talk about how we can help. As you've seen today, detailed tax planning is part of our financial planning strategy. We love doing this. It's exciting for us to play the game before the end of the year, analyze your situation, and see how we can make the most of it in the time that we have left. And we are very intentional about wanting to do this webinar well in advance before the end of the year, because we want to make sure there's enough time, to work with you and explore these strategies further. So I'm sure we prepare a lot of your returns already, but if we don't, we do prepare individual and business tax returns. Jim and I are both licensed enrolled agents, so we can legally advocate and represent you in front of the IRS. So we have the expertise, we have the experience, we have the knowledge, and we're excited to help you maximize these strategies. So we left about 9-10 minutes for questions. Feel free to shoot them in the chat box or the Q&A button below. Give you a few minutes here. We did get one question.
Yeah. So as interest rates for savings increase and investments have moved into fixed income, which is true. I mean, it's been a long time since we are actually seeing any kind of rate of return on money market and CDs and treasury bills and things like that. How are we strategizing our tax situation? Their tax-free interest investments that make sense. They very well could be. It all depends on tax brackets, and it also depends on tax equivalent yield. So we see a lot of people that come in and start working with us where they've got a bunch of muni bonds and they're in, a 15% tax bracket because they hate paying tax. But you're giving up a lot of return by doing that typically. And you're a lot of times with municipal bonds, they're also assuming more risk. A lot of these agencies, there's higher default risk. They're usually long-term bonds, so there's more interest rate risk. And so, yeah, we'll definitely start looking at municipal bonds again as an alternative as rates increase. But at the same time, we look at it from the tax equivalent yield and also the risk that's associated with these. But certainly, you're going to start seeing more 1099 INTs with some interest where, banks have paid zero for however many years. I mean, most cases anymore, they don't even have to submit the 1099 INT if they're less than $10. And we have plenty of clients that haven't seen one in a while. That's going to change, which is a good thing. It's nice to finally start getting some yield from things like treasuries and all of those kind of things. But it all depends on your individual situation. That's why we like to do these year-end reviews and run tax projections to see, are you in a situation where maybe we need to start looking at tax deferral or tax-free interest.
So I'll answer the next one here. Can I use my RMD from a 401k for a charitable contribution? Will it be tax neutral? The answer is no. So the qualified charitable distribution strategy is only available from an individual retirement account and not a 401k, which would be an employer-sponsored retirement plan. So in order to employ the qualified charitable distribution strategy, you would have to roll over the 401k into an IRA, and then you would then be eligible to take money from that IRA. You could do the amount of your RMD and send it directly to the charity to make it tax neutral.
Yeah, I mean, that's another reason why we don't just automatically say, oh, you need to roll to an IRA from your 401k. There can't be a reason to keep it in the 401k. But there are reasons to consider rolling it. The charitable distributions is one of them, as is the ability to convert from IRA to Roth IRA. You don't really have those abilities in the 401k. So it's always an analysis of, what are the cost difference between the two types of plans. Bankruptcy used to be an issue. It's really not much of an issue anymore. And then it's the additional flexibility of an IRA, the ability to do Roth conversions. Usually it's increased investment choices, things like that. So this is one of the reasons we typically advocate, rolling your 401k to an IRA as soon as you're eligible, so that you have more flexibility.
Yeah, I'll throw out one more reason too. In the 401k wrapper, you're subject to mandatory withholding requirements of 20%. So if I take money from my 401k as a withdrawal, I have to send 20% to the IRS right away as a mandatory withholding. And that may not match my individual personal tax situation. So you have a little bit more of a flexibility from a distribution standpoint to adhere to what your tax rate actually is.
Yeah, so that there's another question. How is the RMD calculated? And it varies from year to year. It does. So the essential formula is you take your, let's say for 2022, you take your account balance on 12/31/2021, and then you divide it by this life expectancy table. And it's pretty straightforward. You just go to the life expectancy table for your age. It starts at, it used to be 27.4. I think it's changed a little bit. I don't know, right off the top of my head. So let's say it's 27 years. You divide your account balance at the end of the prior year by the 27, that's your RMD. The next year you do the same thing. So your account could be larger, and now you've got a slightly lower life expectancy. You divide it again, you could have a higher RMD. Or if you've taken money out or we've had a bad market, you're starting with a lower balance, and then you could have a lower RMD. So it will fluctuate from year to year. I would say as a general rule of thumb, it's going to increase every year as you age, simply because we're starting at say 27.4 and we're ultimately going to go down to, it never goes to zero the way they calculate it. But at some point, you're going to start taking huge sums of money out of that. And that's where it starts to become a tax problem. So that's the way the RMD is calculated. It's done by this custodian typically every year. So Charles Schwab or whomever is being used will calculate that RMD, and we have in place checks and balances to make sure that that RMD is getting taken and it's not missed, because the downside is huge. There's never a reason for someone to not take their RMD. There's no tax situation where it's higher than 50%, which is what the penalty is.
Yep. Yeah, it's usually around 3 to 3.5% withdrawal rate. But yeah, as I mentioned earlier, the higher your balance, the older you are, the larger RMD that you'll face. But we do that calculation each year for those that it applies to. I was follow up to the earlier question. Believe it was rolled into IRA at retirement. How can I verify? We could help you out with that, but it should say on the statement, whether it's an individual retirement account or a 401k.
Yeah, and so obviously, if you have other questions or you want to talk about your situation, you can reach out to either Blake or myself. And many of you, we've already sent you an invite to schedule your year-end review. And we tried to make it easy by just having access to our calendar and scheduling a time and date that fits for your schedule and our schedule. But we encourage you to do this. And like Blake said, it's better to do it now where we actually have a couple months to plan than waiting till the end of the year where it's too late to do anything. So we encourage you to take advantage of that. And as always, if we're not doing your tax return currently, we're more than happy to evaluate that for you. But regardless, we're always going to do tax planning. We're looking through the windshield rather than the rear view mirror in all of our financial planning. So you'll be able to view this on our website next week. If you have other questions, shoot Blake or myself an email and we'll be happy to respond or set up a phone call, etc. And so with that, we'll go ahead and let you guys go for the evening. Looks like we're right on time, and wish everybody a great rest of the evening. Thanks, guys. Bye.